Ansoff's Product Market Growth Matrix, developed by H. Igor Ansoff. This matrix is all helping business decide their product and market growth strategy. The core idea is simple. You can grow by selling what you already have or by creating new things, and you can sell them to people you already know or to totally new customers. Where you choose to play determines your risk level. Let's zoom into each square. Market penetration. This is the least risky strategy. You're selling more of your current products to your current audience. Think price promotions, loyalty programs, or increasing marketing to grab market share from competitors. Example, a coffee shop offering a buy 10 get 1 free card to its regulars. Market development. Here, you take your proven products to new customer groups. This could mean geographic expansion, like taking your retail brand overseas, or targeting a new demographic. Example, a successful domestic fashion brand launching an online store to ship internationally. Product development. You innovate for your loyal customers. This involves research and development of new products or services for your existing market. It requires more investment and carries higher risk than the first two options. Example, a smartphone company launching a new smartwatch to sell to its existing customer base. Diversification, the big leap, creating new offers for entirely new markets. This is the most risky strategy. It can be related, maybe leveraging some company expertise, or unrelated, a total leap into the unknown. Example, for related, a car manufacturer starting an electric scooter brand. Unrelated, that same manufacturer suddenly opening a restaurant chain. Ansoff's product matrix classification. Coke has brought two size cans, 200 ml and 375 ml. Classifying the Ansoff's matrix can be quite tricky. Is this 200 ml can a new product development or is it market penetration? One argument is that it is a completely new product as the packaging size is different, marketing is also done differently, and the price is also different, and therefore should be classified under product development. But you can also argue that its current product, as the inside thing has not changed just because marketing and packaging has changed. The Ansoff's matrix shouldn't be used as a rigid labeling system. It should be treated as a thinking tool and not a precise scientific classification. The most effective strategies often exist in the gray areas between its boxes, leveraging elements from multiple quadrants to create sustainable growth. The ADL matrix. Is your business a dominant player in a booming new market, or is it holding on to a niche in a mature industry? As a leader, you have a portfolio of products or business units, and each one faces a different strategic reality. How do you make sense of it all? We are breaking down this portfolio analysis technique, that is ADL matrix, and it derives its name from Arthur D. Little. This matrix helps you manage your business portfolio by evaluating two critical things. First, your competitive position. How strong are you in the marketplace? Second, the stage of your industry's life cycle. Is it brand new, growing, stable, or declining? By plotting these two factors together, you get a clear picture of where each part of your business stands and what strategy it likely needs. Now let's explain these two axes. Dominant. It's a market leader, near monopoly. Strong. Can act independently of rivals. Favorable. Fragmented market, no clear leader. Tenable. Surviving in a niche. Weak. Struggling to survive. And on the right side, it's the industry life cycle. Embryonic. It's rapid growth, little competition. Growth. Market maturing, competition rising. Mature. Stable, slow growth, high barriers. Aging. Market in decline, prices fall. Now let's make it real. Imagine a large company. Its new AI division might be strong in an embryonic market. Clearly an invest and build priority. Its flagship soft drink is favorable in a mature market. The goal here is to defend share and maximize earnings. An old DVD rental service is weak in an aging market. It's probably time to harvest or exit. The visual snapshot helps leader allocate resources strategically across their entire portfolio. The ADL matrix power is in starting high quality strategic conversations and making complex portfolio data visual and accessible. But be aware, it's a subjective tool. Classifying a life cycle stage isn't always clear cut. Also, markets can change fast. So, this isn't a one time exercise. Review it regularly, maybe quarterly, to stay current. Now let's discuss this powerful tool called the BCG matrix, also known as growth share matrix. Invented by the Boston Consulting Group in the 1970s, it's still used by strategists today. In this video, we'll break it down with simple animations and real examples. Stick around to learn how you can think like a CEO. At its heart, the BCG matrix is a portfolio map. It helps businesses categorize all their products or business unit based on just two questions. How fast is the market growing? This is our vertical axis. What is our market share compared to the biggest competitor? This is our horizontal axis. Plotting these answers create 4 distinct quadrants, each with a memorable symbol and a strategic mission. Let's start with the stars. These are your champions in hot growing markets. They have a high market share but require huge ongoing investment to fuel that growth and fight off competitors. Think of them as the engine of future profits. A perfect example, the Apple iPhone. It's a market leader in the still growing smartphone market, but Apple spends billions every year on R&D and marketing to keep it there. Next, the beloved cash cows. These are leaders in mature, slow growth markets. Because the market is stable, they are the top dog. They generate a ton of cash without needing much new investment. The strategy here is to milk them. The profits from cash cows are used to fund the stars and promising question marks. A textbook cash cow is Coca-Cola's classic soda business. It dominates a mature market and prints money for the parent company. Question marks, high growth, low share. Now for the tricky ones, question marks sometimes called problem children. These are in exciting high growth markets, but they haven't yet captured a leading share. They are the big gamble. They need massive investment to try and become stars, but if they fail, they'll become dogs. The key question here is, do we double down or cut our losses? Apple TV Plus is a great example. It's in a booming, dreaming market, but is still chasing giants like Netflix, a true question mark. Finally, we have dogs, low share in a low growth market. They typically don't generate much profit and can tie up resources. The standard advice is to divest, sell or reposition them. But it's not always that simple. Sometimes a dog can have niche value. For Apple, the iPod became a dog as smartphones took over, leading to its discontinuation. But a quick word of caution. The BCG matrix has critiques. It focuses only on 2 factors, ignoring things like brand strength or customer loyalty. Defining the market can also be tricky. Is Apple Watch in the watch market or the wearable tech market? Use it as a starting point of discussion, not the final answer. And there you'll have it, the BCG matrix in a nutshell. Stars to build, cash cows to milk, question marks to analyze, and dogs to ditch. It's a timeless framework for making smarter resource decisions. Now I want to hear from you. What product do you think is the biggest cash cow of all time? Drop your answer in the comments. The General Electric matrix or stoplight strategy model. What do corporate strategy and traffic lights have in common? They both need a clear system to say go, be cautious or stop. For multi-business giants, that system is the General Electric matrix, also known as the McKinsey 9-box or the stoplight strategy model. Born in the 1970s from a partnership between General Electric and McKinsey and Company, this tool helps companies with many different businesses decide where to invest money and effort. Unlike simpler models, it doesn't rely on just one factor. It uses two key dimensions to create a strategic map: market attractiveness and business strength in the industry. Market attractiveness is measured by factors such as market size, market growth rate, industry profitability, competitive intensity, pricing trends, risk, opportunities for diversification, technology availability, etc. Whilst business strength is measured by market share growth rate, profit margin, distribution efficiency, brand image, customer loyalty, production capacity, relative cost position, management caliber, etc. Plotting a business on these axes place it in one of the three zones, each with a clear strategic command. Green zone is invest and grow. This is the sweet spot. Strong business in an attractive market. Strategy is invest heavily, expand and grow market share. The yellow zone, which is selectivity and hold. It's mixed prospects, maybe a strong business in a so-so industry or a weak player in a great market. Strategy is be selective, invest cautiously, aim for steady earnings, or try to improve its position. Red zone, harvest, divest, weak position in an unattractive industry. Strategy, stop investing, harvest remaining profits or sell, divest the business to free up resources for green zone units. So the GE matrix isn't a magic answer, but a powerful framework for strategic conversation. It helps leaders move from gut feeling to a structured debate about where to light the green light for growth.